In this session, we're going to look at financial leverage and financing alternatives for income using properties. So first, let's look at a definition of financial leverage. This is defined as the benefits that may result for an investor who borrows money at a rate of interest lower than the expected rate of return on total funds invested in a property. We have some conditions here. So what's the conditions for positive leverage before tax? The leverage before tax, internal rate of return on total investment in property should be greater than the interest rate paid on the debt. To have a clear understanding of this, we have a formula here. So the before tax internal rate of return on equity is equals to the before tax internal rate of return on total investment in property plus the before tax internal rate of return on total investment in property less before tax internal rate of return on debt, and what you get there, you multiply it by the debt to equity ratio. And we also have conditions for positive leverage after tax. So the unleveraged after tax internal rate of return on total investment in property will be greater than the after tax interest rate paid on the debt. The after tax internal rate of return on equity is equals to the after tax IRR on property investment plus the after tax IRR on the property investment, or rather the total investment in property, less the after tax IRR on debt multiplied by the debt to equity ratio. Another important thing to note is the break-even interest rate. It represents the interest rate at which the leverage is neutral, neither favorable nor unfavorable. So the condition for this to happen is the after-tax IRR on debt should be equal to the after-tax IRR on total investment in property. For us to get the break-even interest rate, we simply divide the after-tax IRR on property divided by 1 less the tax rate. Now let's have a look at risk and leverage. There's an implicit cost associated with the use of financial leverage. This cost is the higher risk as measured by standard deviations. Decision to use leverage cannot be made by looking at the before tax IRR on property and the before tax IRR on equity. The investor must ask whether the higher expected return with leverage is commensurate with the higher risk. Now let's look at alternatives to fixed rate loan structure. We have participation loans. Here, the lender participates in some way in income or cash flow from the property in return for a lower stated interest rate. Lender's real rate of return is hereby protected. We also have sale leaseback of the land. If an investor already owns the land, they can sell it with an agreement to lease the land back from the purchaser. In effect, the investor obtains 100% financing. Also, lease rentals are tax deductible while loan repayments are not. We also have interest-only loans. These are loans structured such that no amortization is required for a specific period of time. We also have accrual loans. These are loans structured such that payments for a specific period of time are lower than the amount that will be required to cover the monthly interest charge. And finally, we have convertible mortgages. This gives the lender an option to purchase a full or partial interest in the property at the end of some specified period of time. Now let's have a look at income producing properties risk analysis. There are different types of risks related to income producing properties. Here we'll have a look at some of these risks. We have business risk. This is due to fluctuations in economic activity that affect the variability of income produced by the property. There is financial risk, which arises from use of debt. Degree of financial risk depends on the cost and structure of debt. We have liquidity risk. This occurs when a continuous market with many buyers and sellers and frequent transactions is not available. We also have inflation risk. Inflation may erode the real rate of return if the income from the investment does not increase sufficiently to offset the income of inflation. There is management risk. This is the risk, or the risk is based on the capability of management and its ability to innovate, respond to competitive conditions, and operate the business activity efficiently. There's interest rate risk. Changes in interest rates affect the price of securities, including real estate. There's legislative risk. Results from the fact that negative changes in regulations can adversely affect the profitability of the investment. We also have environmental risk. The value of real estate is often affected by changes in its environment, or rather by changes in its environment or sudden awareness that the existing environment is potentially hazardous. While investing in income producing properties, you need to have a due diligence in real estate investment analysis. Due diligence is described as an investigation that an investor will undertake when considering the acquisition of a property. A sample due diligence checklist will include the following: rent roll analysis, lease agreement review, review of service and maintenance agreements, pending or threatened matters of review, review of title deed or other deed documents, property survey, and finally, you could also have government compliance. Some of the other things which you can look at also include physical inspection, tax matters, insurance policies, engineering studies, market studies, and list of personal property. So how do you measure this risk? So for risk measurement, you have sensitivity analysis. This involves changing of one or more of the key assumptions for which there is uncertainty to see how sensitive the investment performance of the property is to changes in that assumption. Approaches to changing these assumptions include changing a single assumption at a time, identifying several scenarios in which more than one variable changes within a particular scenario, and variance and standard deviation of tons. Now let's look at dispossession and renovation of income properties. What factors lead, or rather related to disposition decisions? Disposition is a sale of the property. Equity build-up represents funds that the investor will place in another investment if the current property was sold. This is the opportunity cost of not selling the property. You can now try and attempt doing the following problem in relation to decision rule for property disposition. You'll also notice that there is a workout provided in the next page with more details on the net operating income and the calculations for the before tax and after tax IRR. So you can attempt this on Excel, and in case of any challenges, feel free to get in touch. But this practical example will really help you to cement the skills learned in this course. We can now proceed on and look at alternatives to disposition. Here we have different alternatives to disposition. The first alternative is refinancing. The loan may be refinanced and the additional funds obtained invested in profitable investments. The return from the profitable investment will be greater than the cost of refinancing. Another alternative is renovation. The property is renovated, instead disposing. The incremental internal rate of return is computed and compared to the return from alternative investments. Here, you can also try this example on refinancing and the other alternative to disposition, which is renovation. We also have the calculations, or rather the answers illustrated here, but it's advisable to try this practically through your Excel account and try and be able to populate similar answers. In case of any challenges, please feel free to contact us. Now let's look at marginal rate of return. Previously, we computed the return for selling versus holding the property. This is the after-tax internal rate of return on equity. This was based on holding the property over 5 years. A slightly different approach is to consider the return that would result from holding the property only one additional year. This return is referred to as marginal rate of return, also commonly referred to as MRR. So the MRR formula is as follows. The property should be sold when the marginal rate of return falls below the rate of return which the fund can be reinvested. For example, internal rate of return. We also have another example here which you can be able to use to practically try and compute these figures and have a clear understanding. Now let's look at refinancing corporate real estate. Corporate real estate refers to the real estate activities of firms that are not real estate investors. We examine the lease versus own decision. Now here, we also have another example which you can be able to attempt and practically compute the figures required and identify whether you should lease or own the property. Now, with that being said, we've come to the end of this lesson on income producing properties, where we've looked at financial leverage and financing alternatives.